Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a member of the business development team here at ICM, and today I'm joined by ICM's Director of Investments, Ryan Lehman. Ryan, thanks for taking a few minutes with us today.
Always happy to be here, Pete.
So, Ryan, over the course of the last few weeks, we've gotten a number of questions in from advisors surrounding our work and use of closed-end funds in our tactical income strategies. And so I wanted to take a few minutes here today and just cover a few of these questions that we've received. But before we jump in, talk a little bit about and give us an overview, 10,000-foot view, if you will, of the closed-end fund market in general.
Yeah, sure. So at just a really high level, closed-end funds are just mutual funds like open-end funds and ETFs, but they're probably a little more similar to ETFs in that they're traded throughout the day. The big difference, though, is that closed-end funds have a set number of shares, kind of like an individual stock. So shares aren't created and redeemed throughout the day like they are for an ETF. So what this does is it essentially eliminates the no arbitrage mechanism that's built into the ETF structure, which helps to ensure that the fund's NAV trades relatively close to its price. So what happens is that as a result, investors can have the ability to buy closed-end funds at a discount to their NAV, meaning you've got the potential to actually pay less than $1 for $1's worth of assets, and sometimes significantly less. And then one other really unique aspect of closed-end funds is their focus on yield and income generation. Many funds are going to be specifically designed to produce an enhanced level of yield compared to traditional stocks and bonds, which really makes them potentially attractive for income-oriented investors.
Great. So thanks for that. Now let's jump into the first question that we've received. Really good one. Why do closed-end funds trade at discounts?
Yeah, great question. So, just thinking about it from a purely mechanical level, it's exactly what I just mentioned a second ago. The pricing structure, it's a little bit outdated compared to the ETF, where there isn't a no arbitrage mechanism in place to ensure that they don't trade at discounts. But the reason that they do actually trade below NAV is a bit of a deeper explanation. So the closed-end fund market tends to be largely dominated by retail investors. And as we all know, retail investors tend to be very emotional. So this just means that they tend to sell when others are selling, and they tend to buy when others are buying. And this activity is only exaggerated during times of market stress or periods of excess risk taking. Now, this can put extreme pressure on discounts in both directions, meaning that they tend to get very wide during periods of market stress, but they can narrow quickly during periods of sharp market recoveries. And this is really precisely where this unique excess return opportunity comes from. If you're able to develop a process that identifies these periods where closed-end funds are potentially undervalued and purchase and hold them until discounts revert to more normal levels, it creates what we refer to as closed-end fund alpha, a return source that's not really available to traditional mutual fund and ETF investors.
Sure. And Ryan, as a follow-up, do you see that closed-end funds are perpetually at discounts, or are there other scenarios where there are premiums?
Yes. So it's kind of an interesting answer. I would say most of the time, yes. Over the long term, you're going to see the universe trading at an average discount of about 4.5% or so below net asset value. But this varies greatly over time as well as by fund. So some funds, for instance, that may have relatively poor performance may trade at consistent discounts that are wider than this, while we do see some funds that are going to be issued by larger, more popular asset managers like the PIMCOs and the double lines of the world. They actually trade at consistent premiums to NAV.
Great. So next really good question that we received. Can you talk a little bit about the advantage or what we'll do at ICM, and how institutional managers can capitalize on these discounts, and what it specifically is the mechanism that we use at ICM?
Yeah, absolutely. So I think there's a few things to take into account when investing in this space. So first, keep in mind that discounts are mean reverting, which just means that they move up and down, but over the long term, they do tend to revert to their average. This speaks to how important it is to approach this unique space with a tactical approach. Simply using a buy and hold strategy isn't likely to add much value over a
Sure.
portfolio of ETFs, because while you might benefit from discounts narrowing, your performance is going to be hindered when discounts widen and potentially in a serious way if markets are really selling off. Now, we shift our tactical closed-end fund portfolios between closed-end funds and ETFs in order to overcome this pitfall. And ideally, what we're going to do is own the largest amount of closed-end funds when discounts are historically wide, and then conversely, we're going to hold a higher percentage of our portfolios in ETFs when discounts are narrow. This essentially keeps our powder dry, but it doesn't exclude us from participating in general market movements. And then I think the second point I want to make here is that just buying the funds at the steepest discounts is also unlikely to be a winning strategy. So, like I mentioned a couple minutes ago, your average premium or discount to NAV, it's going to vary greatly by fund. So, you may have one fund that trades at an average discount of 10%, while another trades at an average premium of 10%. Now, as a tactical investor, I'd rather own the second fund if it's trading at a 2% premium over the first fund, even if it's at a 12% discount. The reason being is that if you think of your additional return potential or that closed-end fund alpha you could potentially generate, the second fund has the potential for an 8% return, even though it's trading at a premium, while the first fund only offers about 2% despite trading at a very steep discount to NAV. And we take all this into account when thinking about the investment philosophy and process behind our tactical income strategies.
Great. So one last question submitted by our audience. Can you talk a little bit about the fee landscape in closed-end funds and how specifically this impacts our use of closed-end funds in our tactical suite of strategies?
Yeah, absolutely. So this is typically one area of concern when we talk about closed-end funds with investors because they do tend to charge higher fees than ETFs. This occurs for really two reasons. One, they're mainly actively managed, so you are paying a manager who's trying to outperform their benchmark. And then second, some funds do employ leverage, with that cost of borrowing then being counted as part of the fund's expense ratio. So stack those two things together, and they do tend to be a little bit more expensive than ETFs. That said, though, when we look at our strategies, there are a couple things to consider. First, we're tactically allocating to closed-end funds. So when the market isn't ripe with opportunities, we will own a higher percentage of low-cost ETFs, which is going to greatly reduce overall expenses. And then second, when we see the expense ratio of our strategies increase, it's typically when I'm actually the most excited about potential future returns because it means we own a bunch of attractively valued closed-end funds.
Ryan, really do appreciate the time today. Thank you for taking questions that have been submitted by advisors. And as always, if you do have topic suggestions or would like additional information, please do reach out to us at info@icm-invest.com or by phone at 888-426-4689. We appreciate you watching today.